John, Graham, thanks for joining us at our latest Inside Stephensons episode. Tell us a bit about who you are and where you're from.
Yeah, so I'm Graham Jones, one of the directors at Ebor Mortgages, joined by John Nurden as well, another one of the directors at Ebor Mortgages. There's Nick as well, who's another director. So we are an independent mortgage brokerage based in York. We've been going for 2.5 years now, just over 2.5 years. We've all come from a background of a few major banks, a few building societies. That's where we cut our teeth really, and then moved into the independent world, the brokerage world, a fair few years back. And since then, we've worked together at different companies, and now we're all working together at Ebor Mortgages.
And how are you finding the financial world?
Yeah, do you know what? It's a lot better than it was towards the end of last year. So, don't think it's a secret that sort of September, October last year were pretty tough for us and for a lot of people in general. We had the whole sort of Liz Truss debacle, which sent mortgage rates spiralling. And, it was a turbulent time, and there were times where we didn't really know what was going to happen. But over the last 4 or 5 months, things have settled down, and we're sort of starting to see a little bit more of normality return.
And you think the appetite's still there?
Yeah, people are still wanting to buy, and I think sometimes living in York, we can feel a little bit like we're in a bit of a bubble, but we do definitely still see people looking. First-time buyers, I think especially, for them, interest rates are more expensive than they were without a doubt, but for a first-time buyer, what they really care about is the monthly payment.
Yeah.
So for them, if they are facing a choice of renting a place for £1,000 a month or being able to buy their own place for £1,100 a month, whether the interest rate's 2% or 5%, for them, does it really make that much of a difference? I'm not sure.
Can you give us a bit of an overview as to what sort of is your day-to-day sort of role and bits and bobs?
Yeah, absolutely. So, we deal with clients in York, but we deal with them nationally as well. So, there's a variety of different ways that we can speak to clients these days. And you don't have to be in York for us to help them, really. But we do all sorts of property finance. So our main area of business is residential. So main residential, so if you're a first-time buyer, if you're moving home, if you're remortgaging, coming to the end of your deal. But there are other areas that we look at, so buy-to-let, investment market.
Sure.
Other smaller areas as well, so equity release.
And it's not just in York that you've sort of got clients all over Yorkshire, haven't you?
Absolutely, yeah. So we're finding, as we've grown as a business, the main source of why people find us is our existing client base, and we deal with people. We have a lot of clients in London, a lot in Manchester, a lot down south as well, and it's sort of on a good service basis that we find that client base grows.
Just talking about your client database and I guess interaction. I know when I first got a mortgage, if you like, you went and sat in an office, took all your paperwork. In today's world, clearly there's a lot more online interaction. Are you still keen to sit down with a customer in front of them in their home, in your offices? Do you find that more beneficial? Do you think you find out a little bit more about the client and what they're after, or is it mainly over?
It completely depends on the client. I think, if you've got a buy-to-let landlord who's buying the 10th property, they're probably going to be less keen to sit down and discuss things in lots of detail because, you've tend to have gone over things in the past and it's more of a kind of a process. But first-time buyers, people like that, they're going to want to spend more time. So if there is a sort of certain type of client that we tend to spend more time with, it would be the kind of first-time buyer. But, we can do stuff either over the phone, email, video conference, we can go out to see people. So I think the pandemic really was the big shift there. Prior to that, most of the stuff that we did, we'd go out and see people. And then obviously with the pandemic, people were not so keen on you going in the house and then it's just kind of never really reverted back. So we just find now there's just less and less demand for people wanting to do face-to-face.
I guess that kind of rolls into some of the questions that we had for you, which were just focusing on first-time buyers for a short period of time. Clearly they're really important to the market and the food chain of people moving up and down the ladder. I think one thing that really interests me is what sort of reaction have you had from, as you mentioned, the Liz Truss situation, the mortgage debacle, as you refer to it. in that period of time of a couple of weeks after it happening, people thinking that they could get really attractive rates as first-time buyers, to within a matter of weeks those rates being out of reach for many. What's the reaction been from, what have you been hearing, what have first-time buyers been saying to you?
So I think there is still big appetite out there from first-time buyers. There's still people that we spoke to 2 years ago, 3 years ago, that are still looking, that have unfortunately, maybe missed out on properties, and they are still wanting to buy. It's an achievement, it's a dream to be on the property ladder.
Absolutely.
And that is always going to be something that they want to achieve. So I think, since last October, when things went a bit array in the markets, I think there was maybe a bit of disbelief that rates may return quickly back to where they were. But, that's not happened. They've sort of, got to a level now that we haven't seen for the last 14 years. But I think with first-time buyers, they just have to adjust their budget, really, or adjust the mindset. It's, still potentially achievable, but they may have to cut back on, a few life's luxuries to squeeze that budget or make that budget work a bit more. But it is still very much achievable, and we're seeing lots of appetite for it.
And the other thing is as well that first-time buyers have I don't know whether you call it, say, good fortune, but they don't have anything to compare it to. So it was worse.
Isn't it?
Yeah, the worst ones were people who were, bought maybe 5 years ago, had got a rate at, 1.5%, and then you're having that awkward conversation of it's now 5%, 6%.
Yeah.
Suddenly your payments are going up £400, £500, £600 a month. That's an issue.
Yeah.
For anyone. But for a first-time buyer, like I said at the start, they care about the monthly payment. Yeah, obviously, if they could get it cheaper, they'd rather have it cheaper. But the interest rate itself is less of an issue.
I guess there's a lot of heart purchasing, isn't there, from buying with that heart. I think as you get a bit older and you maybe go up the ladder, there's a bit more of head, isn't there, involved in the investment and the purchase. Yeah. With first-time buyers, clearly it's a daunting process. How involved do you get with them in terms of working with the agent, in terms of giving them any advice in terms of the offer that they might make or how they might present that? What are you doing for first-time buyers, and what are you wanting from them when they come to you?
I think there's always a fine line there, because ultimately, they need to be the ones that decide what they're comfortable offering, and they need to be the ones to put the offer forward. We certainly won't get involved in a negotiation or anything along those lines.
Yeah.
But I think for us, it's about sort of sitting down, working out what their max purchase price is, what they feel comfortable going to, and setting a limit and working out what the cost would be based on that, and then letting them go. And if they come back and say we need to pay 10 grand over the ask or whatever, we can remodel the figures from there. But
I think really interesting. Off camera, we were talking about some of the things that we want from first-time buyers, if you like, and I think there's one thing that I don't know how much Tom sees it at Selby, but certainly in York we've had experiences of IFAs and financial advisors, mortgage advisors getting involved in that first-time buyer purchase, and it's not for me to tell that IFA not to be involved, but I feel a bit sad, I guess, for the first-time buyer, because that's an experience for me. It's the first time you're ever going to do it, and it's a time that I've got no problem with them doing it either way, but I've always felt that from a first-time buyer perspective, having someone in the background helping you with that proposal of that offer is really important. But I say, talking off camera, you said, what was it that first-time buyers, we want from first-time buyers? Well, build a rapport. And if your financial advisor or your mortgage advisor's in between that, then clearly you're losing that rapport between the agent and the buyer, which is going to hopefully find out some information that we can pass on to a vendor, which could make the decision a lot easier. So it's interesting to hear that you say you don't, unless they ask, to specifically take
even
that
if
on.
they asked, if I wouldn't, just wouldn't get involved. I just don't think it's for us to be that sort of go-between in terms of it then becomes sort of us acting as an agent for them, speaking to you as an agent. It's not our role. We're not there to tell them what to buy or how much to pay.
A lot of our job is educating people. So we are here, we spend a lot of time talking people through the whole buying process. So when they come to us the first time buyers, if they want to have family with them, parents with them, extended family, that's fine. We'll sit down and take the time with them. But then we go through, from start to finish, the whole property process. So who gets involved? The estate agent, solicitors, underwriters, valuers, surveyors, and we talk them through it, and we'll hold their hand all the way through. We're not a service where someone comes to us, they've then got their offer, that's it. We are dedicated to seeing it all the way through to completion, because that's inevitably how we work.
I think the only times that we might sometimes step in and not step in and say you shouldn't buy this is where you see a first time buyer and they maybe look at taking on a project that looks pretty hefty.
Yeah.
They've not quite got their head around exactly what might be involved.
Yeah.
We're not going to turn around and say, don't buy this, but it might just be a conversation around, look, have you really looked at what what's involved? Do you know what the sort of the process and how it would work? In those situations, I think we have a duty of care to make sure that people don't make a.
So whilst we're talking about first-time buyers, for any of them that might be watching this, if they're looking to buy a home and they need some mortgage advice, clearly come and see you guys. For them to help you with the process, what are you looking from them to provide to you in the early stages for you to be able to give them some as accurate figures as you can do to enable them to come into the market to buy?
Yeah, so, if we have first-time buyers that approach us, the main things that we probably flag up with them first is deposit. So where's the deposit coming from? That can be family members, can be savings, can be a wide range of places that they can achieve that from. And then credit as well. So credit has become a massive thing. Credit profiles, your credit file. You will see all the adverts on TV for credit scoring. And that does play a big part now in mortgages. So having your credit in a good position. So if you want to obtain a credit profile 6 months before you start looking, just give it a check over, see that everything's in place that it should be and there's nothing on there that shouldn't be. And then deposit-wise, making sure that you've got probably at least a 5% deposit, as that's where the products do start, those sort of ranges, to then begin looking with your search.
Yeah, and I would say another thing, that get your bank statements in order for the 3 months. I know sometimes it can be quite funny to send money to a mate with a reference on. Trust me, underwriters don't find it funny.
I think we've all been there with that
exactly,
one.
Yeah. So that they will look at something like that, and I have seen it in the past with some questionable references on, and underwriters have asked questions.
Really?
I believe people have actually had applications declined.
Because of what the reference was on there.
Someone's put something stupid on there.
I think something went viral, didn't that? Was it last year or the year before? I saw that.
You talk about getting your ducks in a row and getting your finances in order. Is that just for first-time buyers, or would you say that to everybody?
For anyone. And I think as well, there's sometimes a bit of a misconception that an underwriter is going to comb through the statements and going to go, well, why are you spending 50 quid a month on the gym and why are you spending money here? And it really isn't like that. It's kind of stuff like, don't be going over your overdraft limit. If you can avoid it, don't go into your overdraft. But if you do, it's not going to be the end of the world. You probably want to avoid taking out new credit for 3-6 months before you apply. There's another misconception that people think, well, I haven't got credit, so I can't get a mortgage.
Yeah.
And that is just a complete myth.
How are you... Sorry. No, I was going to say, I was reading an article last year that was saying that online betting can be quite bad for a mortgage application.
So I think...
What's your views on that?
If you can avoid it, or, if you do it as a hobby or something on the side, then, there's so many betting companies out there at the minute, and there is people that, have a tenner here, there on each weekend. And, if it's out of control and it causes a problem for the underwriters, if they start looking at bank statements and they see transactions every day, multiple transactions, then that will cause red flags. Yeah. If it's sort of a level where it, once or twice every couple of months or something like that, may not be an issue, but it ultimately comes down to the underwriter's discretion and their risk appetite. Right. So if you can avoid it, then I
think it comes down to plausibility with that. I think if you've got someone on 250 grand and they're spending £1,000 a month gambling, that's probably not going to be too much of an issue. It's probably not going to look fantastic. But if you've got someone on 20 grand a month and they're spending £1,000 a month on gambling, that is going to get picked up. I have had it in the past where I did have someone who was gambling quite heavily and kind of thought that we may have some issues, but the underwriter looked at it, and when they sort of balanced their account over a period of time, they were making a profit. And they kind of just kind of said, well, it kind of looks like it's sustainable, and it was almost like a little bit of a hobby. So they kind
just
of
going
let
back
it
to
slide.
credit, you mentioned about trying to get your credit file in a good state. I remember when I was early 20s, and there was an agent I was working for at the time. I wasn't at a stage where I was ready to buy a property, but I was asked to go and by the in-house advisor at the time to say, do you want to come and have a look at planning for the future of buying a property? Yeah. And I came out of a meeting with her quite surprised actually, because I'd never had credit cards, I didn't have any bad debt, but she sat down with me and said, go and get a credit card.
Yeah.
And I found that really strange because I'd always been brought up to be, you buy what you can afford, and if you can't afford it, you save for it, which is maybe a slightly different generation to where we are today. But her attitude was that go and get a credit card with a small limit on it, put your petrol, which was her advice at the time, every day you come to work, you put petrol in your car, put your petrol on your credit card, and then pay it off at the end of the month. And I guess it's something I've done ever since. Is that something that is going to help you with a lender?
That it can, so if you do it and use it responsibly, it should improve your credit rating in theory. So it's certainly not a bad thing to do. But what I would generally say to people is that you should only do that if you think you've got the discipline to do that. Because
it comes down to the individual.
I think you stand a much better chance of getting a mortgage in a position where you don't have as much credit history versus someone who's got credit history, but actually that credit history is not that good because they took the advice of someone, took a credit card out, said they were just going to put the petrol on it, and suddenly, they've gone 2 weeks to Ibiza and, off we go. That's going to, that is going to do more harm than it is good. So it depends how you're going to do it.
No, that makes a lot of sense. It's interesting though, isn't it, that you kind of have to go and prove to a mortgage lender before you borrow money from them that you kind of got to, in your early stages, the earlier you can start planning to prove your credit it's an interesting world that we live in to do that.
There's definitely people who would find it difficult to get unsecured credit that could get a mortgage though. Because unlike, a credit card where you can rack up the, go over the limit or up to the limit and there's nothing that it's secured against, ultimately you have a mortgage, there's a house there that they can come and take if they absolutely have to. So in some instances, reaching a level to pass a credit score for a mortgage could potentially be easier than certain,
because they've got something to secure
credit.
Yeah. And I guess finally on credit and on how that's probably changed over the last 2 decades or so is that I guess the ability to buy cars now, brand new cars, expensive brand new cars at, for guys our age, when we first started buying cars, there's no way you were going and buying a car with a PCP at 300, 400, 500 quid a month and you turn out the garage in a 30,000, 40,000 pound car. You'd have had to have HP'd it or gone in with with cash. What's your advice to people who have, maybe lived at home with their parents, enjoy driving around in a nice brand new car for the last couple of years? Would the advice be look to maybe lose that payment, or a lender's going to take it on board in terms of affordability?
Yeah, so in terms of when lenders look at affordability, they will look at credit commitments. So how high are your credit commitments, things like credit card balances, personal loans, car lease agreements, student loans, things like that. And if they are higher, or if they are there, if they're present, they sometimes will have an effect on the amount you can borrow. So you might have someone on a really good salary, but if they've got really high outgoings, such as nice cars, £800-900 on a PCP for a really nice car, that could really knock down the amount that they could actually borrow. So when you first, if you are living at home and, you don't have the overheads of your utility bills, gas, electric, everything like that, and think, I've got a nice disposable income, but actually if you are planning, to get your own place, forward thinking, it's all in the planning about, right, well, if I've got that, if they spoke to a broker, 2-3 years before they were looking at buying and figured out roughly how much they could borrow then, they could then put themselves in a position for 3 years' time where they'd be like, right, I'm going to have to reduce that, or I'm going to have to get rid of that altogether.
Yeah.
So it's all in the planning really when it comes to it.
All comes down to affordability, and if the job matches the car, generally speaking, it'll be all right.
Yeah.
If you've got someone who's got a Range Rover and a relatively modest income, that's probably going to cause a problem. If you've got someone who's a massive salary with a Range Rover, it's probably not going to cause a big issue. So it's all relevant really.
Just touching on sort of guarantor mortgages, are they still available?
Yeah, so the old traditional guarantor, someone just sort of vouches for you and says that they'll pay the mortgage if you can't. That kind of has disappeared really, and it's moved over to something that they call joint borrower sole proprietor. So not available through for every lender. So there's only certain lenders who will look at it. But basically, how it works is, generally speaking, it'd be a parent, but it can be brother, sister, auntie, uncle. They would go on the mortgage with the buyer, and effectively their income would be used towards affordability, but only the buyer would be named on the deeds.
Okay.
So 2 people, or even 3 or 4 people on the mortgage, 1 person on the deeds, and the big difference there is that gets around stamp duty. So
Yes.
mum or dad or whoever it is doesn't have to pay the additional stamp duty. The only, you do need to take independent legal advice when you're doing something like that, because mum, dad, auntie, uncle are then in a position where they're responsible for the mortgage but don't have any sort of control over the security.
And does the guarantor have to inform any other lenders that they may have borrowing with?
Yeah. So if mum and dad, so all their circumstances have to be taken into account. So if they've got mortgages in the background, they'll also all have to be factored in. And then, as you rightly say, if they go on to try and apply for a mortgage in the future, they'll also have to take the mortgage into account. And it's the full mortgage, not just their portion.
Their proportion.
Yeah.
So something that I think we both come across in the agency world and in our personal lives have been people have asked us questions on, I missed a mobile phone payment when I was 21 and I'm now thinking about my first house. They think they're blacklisted, they're never going to get a mortgage. Is that a misconception or is that reality?
The short answer is no, it's not, but it does depend on the situation. So one common thing that we see, and it seems to have been happening more over the last few years, a utility provider's been pretty quick to slap a default on someone.
Right.
So we'll see, I'm not going to name names actually. Someone's maybe had a very, very small payment on the account, they've forgotten to cancel it, not realised, moved house, whatever it might be, and the next thing you know, they've got a default for 25 quid, which seems innocuous and is innocuous, but can cause real issues. For some lenders, that is literally just going to be no, I'm not interested, you're going to have to wait 6 years and it's gone, and then we'll look at it. So there will be circumstances where people have not gone to a broker, which is absolutely fine, but they've gone direct to a lender. That lender just happens to be one of the lenders who isn't willing to take a view on something like that, and they're then told you can't get a mortgage. And I'm sure there are then people who go, I can't get a mortgage.
Yeah, well, you might remember a conversation that we had probably 4 or 5 years ago where I was it was buy to let with a chap, and he had multiple properties, good cash deposits, and he'd sold his business. Yeah. And when he sold his business, the chunk of money had gone in his bank account, but cash flow monthlies weren't coming in. Yeah. And for a short period of time, he had a conversation with his lender. That lender had said to him, "It's not a problem, Mr. Owner. We'll give you a holiday." Now he thought, brilliant. Yeah. Whether they did or whether they didn't explain the terms to him or whether he didn't read the terms, I don't know. But I remember us applying for a buy-to-let mortgage and getting a call from the advisor to go, "Sorry guys, but your mortgage is being turned down." And we're looking at each other going, "What? Yeah. Why?" Yeah. And it transpired that the lender that he had paid the mortgage off in question, and that lender had held a report on his file which said, Mr. Owner of property missed or had a holiday on his payment. Now, in the end, the way we would have got around that is that we could have taken him off the application, put just an individual on the application, and they'd have lent to us. But together, they weren't interested. And, I find that incredibly frustrating that lenders out there would allow someone to try and help them, but then put a black mark on their name for a period of time because they were trying to help, not because he necessarily couldn't afford to make the payment. And are the rules and regulations out there where they should be being pretty clear on? They should
definitely be explaining exactly what it is and what the impact of having a payment holiday.
And this was before COVID.
I can remember.
Holidays in COVID were kind of the norm, weren't they, for many people? But this wasn't before that.
I think personally, for me, anything, any sort of arrangement with a lender that is outside of your contractual arrangement, unless you are making a change, changing the term or something like that, I would be very, very wary of, and just make sure you speak to someone outside of that firm before you do it, because that's a perfect example of where someone thinks that they're doing something that isn't going to cause any major issues, and in reality shouldn't, because there's a story behind it, but it does. And unfortunately, you can't undo the past. So once it's done, it's kind of.
I remember him saying to me,
"Had I known."
Yeah.
Never done it.
So they used other available cash.
Absolutely.
It was just I thought that they were trying to help.
It's the same with, which always baffles me why certain lenders will not look at the example of a utility company putting a £20 default. do you really think that if someone knew they were going to stick a default on you would not pay a £20 bill? I mean, the reality is, of course you would. Of course, it's different if it's £5,000 or whatever it may be, but those small ones that can cause an issue, they are frustrating, but I suppose the answer is you can still get a mortgage.
Do you find that there's a bit more of a specific lender that will look at those with worse credit?
So there is, there's well-known lenders on the mainstream lenders that have sort of mainstream rates that are more lenient with their credit profiling. If you're in the industry, you know exactly who they are. But, it goes back to, if you go to a bank direct, they will have their one set of credit profiling and you'll either meet it or you might not meet it. Yeah. Whereas if you approach a broker who looks at sort of whole of market deals and can look at, a variety of mainstream lenders, they'll sort of know, they'll have a good gauge. And if you do have a credit blip, if you have, £25 default or something, then there are a handful of lenders mainstream that will discount sort of mobile phone communication defaults or utility defaults under a certain limit. So there are options there. It's just educating people to know that there are options there.
And on the other end of that then, someone who, has sadly come into financial hardship in a big way, clearly there's going to be a period of time that they're going to have to rebuild and get themselves in a position where they can buy another property. That's not going to happen necessarily overnight. But what are they going to have to do in years to come, let's say 5-10 years time? What are they going to have to do to prove to a lender that, yes, they've had a mishap in their finances over years, whether that be due to a business, whether that be just things out of their control or even in their control? Are you saying to us that, if I've gone bankrupt, I'm never getting another mortgage, or are we saying mainstream might stay away from us and there might be some specialist lenders?
Yeah, time's big healer with credit, and most lenders are really looking at the last 6 years. So after 6 years, a lot of things are going to drop off and not cause as much of an issue or any issue at all. I think the other thing as well, it comes back to the story and the plausibility. I have seen it where people have had really, not great credit, but there's been a reason, a life event. I don't know, maybe they've got cancer and had to have 2 years off work. During that time, they've had to rely on credit. And in that instance, for some lenders, if they can, take time to understand the story, they get, this is where we were, this is what's happened, and this is where we're going. Some lenders will take a view on it. So, I think with any of those situations, you need to just speak to someone and lay it out. We're not going to be able to solve every problem. For some people, the answer will just be, you're just going to have to wait. Yeah. But for most people, you can normally find a... Yeah.
I think it maybe falls quite nicely into something that's just popped into my head, which was more on the self-employed basis. That we've, off camera, we've spoken about this on a number of occasions, and the situations that we've had to customers ours, or even individually, where you had a mortgage with a lender. Yeah. That lender was quite happy to lend to you as an employed individual on X amount of money with a X amount deposit, and then all of a sudden your situation changes, that you have become self-employed, and your earning capacity then may go up. But there's been so many circumstances, and not just individually, but across my years in the industry, where lenders have then gone, no, I don't want to know about you anymore. Yeah. And the gentleman or the lady's gone from earning capacity here to earning capacity here. So actually their finances are in a far better state, but because they don't have that lovely tax return of 1, 2 or 3 years behind them, that lender's gone, no, I'm not interested. I think my biggest frustration is that individual could go, I can't get a mortgage now, so I can't move. Yeah. And from us as agents' point of view, they then don't ring the agent to get them out, because their current lender has gone no, and they think because one lender says no, that they're not going to get another lender. And I say no from personal experience, that there's that disheartening moment when you think, I'm stuck where I am right now, and I need to move for life reasons.
It knocks the market as well,
absolutely.
About it.
But I guess the question I'm asking to you guys is, if someone that's watching this finds himself in that situation, what are the options?
Which we've all been in.
Yeah.
So, I mean, lenders are not shying away from lending to self-employed people. There seems to be sort of a myth, or a historic myth, that it's really hard to get a mortgage if you're self-employed. Yeah. If you are newly self-employed, potentially, because what lenders go off, like you said, Ollie, is a track record. So they'll want to see 1, 2, 3 years of tax returns or tax calculations. And it does depend on if you're a limited company, if you're a sole trader, if you're in a partnership, the percentage of shares that you own within that limited company, how that lender will assess your income. realistically speaking, you know, if you have gone from a permanently employed role to a, you know, sole trader or 50%, 100% limited company director, you will need at least 1 year's of accounts or 1 year's tax calculations. There are a couple of lenders on the market that will look at potentially lending after just 1 year you have been self-employed.
Okay.
However, the majority will take an average of 2 years or need 3 years books. And that is what we see. But again, it's just knowing your options when you're self-employed. They may pick the phone up to their existing lender, and that lender might say, right, we need 3 years of accounts and we'll take an average of the last 2 years. However, they may speak to a broker, a whole market broker or an advisor and go, yeah, we've got someone who'll actually do 1 year's of accounts. And if their income has increased since being permanently employed, then they might be able to, you know, they might be able to borrow what they need to borrow.
I do have some sympathy with lenders on self-employed because it is very backwards looking.
Yeah.
You know, they don't have any way of knowing what you're going to earn. So you could have a situation where someone is having the worst year of their life business-wise, but the last 2 years were really good, and they won't have any issue borrowing money. And you could have the reverse situation, and they're going to struggle. So it is difficult.
But I think the employed situation is only a vehicle, isn't it?
Yeah,
You know,
yeah,
ultimately,
yeah.
you might have Mr. A, who they've had in their industry, they've had 2 brilliant years, of big commissions, of big bonuses, and then for whatever reason, the owner of the business become unwell, and then all of a sudden the business no doubt. But actually, the lender's looking at it that John's earning X amount a year, and he's earning it 2 years, and doesn't actually then go and look at you know Steve Smith, the mortgage lender, whose lads have been doing really, really well. And then go, oh yeah, but the business isn't doing it. They're purely looking at the individual. And when it comes to self-employed, you know, as most of us sat around here are, they're looking at you really deeply as an individual and as a business. But when it comes to you as an employed member of staff, they're not doing that. So it frustrates me massively because why don't they look at, you know, I know they're not going to be able to go to Sky, if you're working for Sky, and say, let me see a set of your accounts, because they're going to say, no chance. But, you know, you see the point I'm coming to.
Yeah, absolutely. Yeah, and it is definitely a frustration, without a doubt. It's just one of those, I think with self-employed, the best advice I can give to self-employed people is speak to a broker and find out exactly where you stand, because unlike someone who's employed and, you know, on a salary, you could roughly say, well, times your gross income by 4.5, and that's going to be kind of there or thereabouts. With self-employed, it just completely depends, because some lenders, as Graham said, are going to go and look at tax calculations, tax year overviews for the last 2 years. So they'll look at your salary and dividends. Others will look at the latest year's salary and dividends. Others will look at salary plus your share of net profit. So there's so many different ways you could do it. And you can definitely have scenarios, and there's a kind of a common theme here with mortgages that, you know, one man's trash is another man's treasure. So you can have scenarios where you go to a lender and they say, you know, yeah, we could do it. We could lend you 100 grand. The very same person with the same accounts could go to another lender and they could say, yeah, we could do it. We can do 200 grand.
Yeah.
You know, you do sometimes see those big disparities just because each lender has their own different way of looking at things.
Do you find it takes the lender a longer period of time to actually come to a decision whether they're going to lend or not if they are self-employed to somebody that is employed?
I think...
Do you find that?
It depends on the business and how it's set up.
Sure.
If it's straightforward and they're looking at, you know, salary and dividends for the last 2 years, they kind of would just treat that as an employed case. It would just kind of go through, wouldn't really be any issue. If it's, you know, a bit more complicated and you're looking at latest years or things like that, then, you know, they might start to ask more questions. During COVID, there was a definite uptick, wasn't there, in terms of what they were looking at. So they were asking for business bank statements. They wanted to know about COVID bounce back loans, how it was trading, etc. And it got to the point where they were almost like selective of the industry type. Right. So if you said, I'm a self-employed DJ, they're probably not going to want to do that during COVID. So, but generally day to day, they're looking at the figures. If the figures stack up, sometimes there might be a bit of a plausibility question.
Do you think there's going to have to be some kind of review on the self-employed model self-employed mortgage world, because clearly COVID's affected that massively, hasn't it? There's so many more people who have gone self-employed and decided to break off on their own. So I don't know what the percentages are, you might know, but surely the proportion of employed mortgages over self-employed mortgages, we're in favour of employed mortgages, but surely there must be a movement that's been made due to so many people going going self-employed?
We see loads of self-employed, but that's kind of anecdotal. And I think if you're self-employed, you're more likely to go to a broker because you know it's going to be complicated. So difficult to to comment on that exactly. But
I think lenders have, if you look at track record of how they've assessed self-employed people, if there was going to be some massive change, it'd have potentially happened by now.
Right.
Whereas
okay.
I think they will potentially continue to look at how they do it, whether that's from tax calculations, sharing net profit accounts.
Yeah.
There's no other way of demonstrating it. I mean, just one misconception that we come across a lot is people who have a limited company, who are a director of that limited company, and they say have a share over 20% or 33%, and for 3 months they will up their salary, or they'll say, I've had a salary increase 6 months ago, and they've started paying themselves 70,000 instead of 20,000, and they'll think because they are employed by that limited company, they'll be classed as employed and they'll be able to use that income.
Right.
However, because they are usually with lenders, it's over 20%. If you own 20% or more of a limited company, you are still self-employed. So they will still look at tax returns and accounts. They won't take those pay slips. So you get a lot of people thinking, oh, actually, yeah, I'll up my salary and in a year's time I'll look at moving, or in 6 months' time I'll be able to borrow this amount.
So would that affect someone then who was, let's say they were a director of a firm and they had 25, 30, 40%, but actually weren't actively working in that business?
Yeah.
That could affect them.
Yeah, so they could use dividends in that instance for affordability rather than.
Just touching on age, is there an age limit to get a mortgage?
Yeah, so age is a big one really, and I think over the last 10, 20 years, because there's so many more lenders that have come into the market, there is a lot more flexibility with age now. So there's some lenders that will go up to the age of 75 on PAYE income. So if you're employed and it's plausible to work up to the age of 75, they'll look at that. A lot more people are working a lot longer now, choosing retirement at a later age. And lenders will take a good look at that. There's some that will go up to potentially the age of 80. But, it's always important to think, to try and get your mortgage paid off as soon as possible to give yourself a good standard of living in the later years. I mean, age of 18 to start looking at buy-in, if you're fortunate enough to be that young and look at buy-in. But yeah, I think a lot of people come to us and they think they're too old. They'll say, I'm 55 or I'm 60, I'm never going to be able to remortgage or get a mortgage. And you'll be like, well, actually, we've got lenders here that may look at using your income now for another 15, 20 years, and they're just not aware of that.
In the right circumstances, there isn't really an age limit.
Yeah.
Especially if someone's got something like a really strong defined benefit pension, they know exactly what they're going to get for the rest of their life.
Yeah.
There's certain lenders who just are happy to accommodate that.
You do hear a lot of that, don't you? I'm too old to get a
Yeah.
mortgage. It's good to hear that. Actually, there is options if you're a little bit older.
And on the other end of that, then, in years gone by, there's been situations where mum and dad have thought we'll buy a property, but we'll buy it in younger siblings and kids' names, for example. Is there an age limit for someone who's been gifted a huge chunk of money by mum and dad, and they're at an age? Is it 18? Is it 16?
On the lower end.
On the lower end.
Yeah,
18.
It has to be 18.
Yeah.
Fine. Okay. So just moving away from age, I guess something that's really hot topic for Tom and I at the moment is how the market's changed from the estate agency side, but clearly that has a connection with what you guys do. We've seen big shifts in where the interest has been coming, what types of properties have been in main in interest, and for us it's mainly been mid-range stuff. People who are having to move, people who have families, need another bedroom, can't extend, can't do the loft conversion, whatever it might be. We've definitely seen there's still an appetite at first time buyer level. Much more thought out process than jumping on something really quickly like it maybe used to be. But certainly in the second and third time movers, there still seems to be an appetite there, albeit I think subject to the right properties coming on the market, which I think we all know is a frustration at the moment. Does that marry up with what you guys are seeing, and where have you seen the changes in the market for you guys?
I think first time buyers are always there, aren't they? We always have people who are keen to get on the property ladder. I think the area that and again it's anecdotal, we don't have thousands and thousands of bits of data, but it's those sort of second or third moves that have been impacted where...
Like your middle market.
Yeah, exactly, yeah. So the ones who were maybe, ideally, aspirationally, we'd maybe like to move to an extra bedroom, a bit more garden, whatever it might be. But because of the change in rates, that's suddenly gone from being achievable to all of a sudden, it's a real big step. Yeah. And I've seen more people say, taking stock and say, well, actually, if we're not going to look at moving, because we, maybe don't want to pay the extra payments or don't want to cover the stamp duty, etc., what can we do to the house? And see more people looking at extending, renovating, etc.
Yeah. I think that I've certainly noticed, and Tom and I have had this conversation where the value, the free valuations that we do for clients, I think there's often been an ulterior motive to some of the appointments that we've been to, which are, let's see what the house is worth now in relation to what we think we might be able to buy based on what you guys have told them from a valuation. But at the back of their mind, they've been thinking, actually, do we stay? Do we extend? Which then comes back to you guys possibly to release some more funds for them. Allow that. Are you seeing people come in for further advances and other sorts of loans to renovate and improve and extend? Yeah,
absolutely. So we see, a lot of the time when people come to the end of the deals, if their plans are to remain in the property, it is looking at, especially if the New York area and you benefit from house price growth in the last 2 years, values have gone up considerably, so there is some extra equity in there. And if they want to pull that out to do the work on the property, that's great. I mean, we all know the fact, though, that material costs have increased. So actually looking at the cost benefit of extending or renovating where you are in comparison to moving, the distance between the two may have become shorter and shorter. But it's all personal perception. It's if that person makes that move, they will probably find a way of doing it and make it happen, and there will be a way of doing it. Or if they do want to extend where they are, there's always that option to look at borrowing the extra.
I was chatting to a friend of mine only a couple of months ago, and he was thought about extending his house, and he'd been asking me roughly what we thought it might cost to extend his house, and I think when we threw the figures at him, like you say, because of material and labour costs, it was a lot more than he expected. And we kind of got into how we might fund it. Now, it wasn't really any of my business, but it's the way the conversation flowed. And I said to them, well, look, when did you buy the house? And we started talking about when they'd bought the house and what the house might be worth. And he had a good idea of what the house was worth. And I said, you've got a huge chunk of equity in there. And I mentioned the phrase further advance, and he looked at me like I was off Mars. And he said, what, I can have 2 mortgages? And I said, you can have 3, you can have 4. And I said, you need to speak to some experts I can't advise you on this, but you need to. So he was completely oblivious that he could go back to his lender and say, give me 50 grand, give me 60 grand, which is probably what his extension was going to cost. And even in the rates that we're in today, we're still going to be quite an affordable way of of creating what he wanted without the cost of moving homes. He's no good for us guys, but ultimately the reasoning for doing it was sensible, and that the money that he could borrow was probably going to be quite.
The only thing with that we sometimes do see with people is it is affordability based, so it is a new mortgage application. You sometimes come across people who say, I want to take some equity out of my property, and then when you start talking about affordability, they sort of say, well, it's my money in there, why can't I just take it out? And it doesn't work like that. You are borrowing the money. So, but as you say, subject to it being affordable and the lender being happy with it, then it's an option.
One thing that really interests me is the investment in the buy-to-let market. Can you just sort of give us your opinion and thoughts on that?
Yeah, it's definitely more difficult than it was, 6, 8, 10 months ago. That's, without a doubt. And it all goes back to the rise in interest rates. So generally speaking, unlike a residential mortgage where a lender is going to be looking at your income and your outgoings to assess how much they can lend, it's all focused on the rent, and they take that rental figure and then apply a calculation to spit out an amount of what you can borrow essentially. And it's quite a sort of black and white process, and the way that they determine that is based on interest rates. So because interest rates have gone up, they're forced to stress the calculation at a higher level, which you just has seen a reduction in the amount that people can borrow. And it has a big impact. So in certain instances, you're talking tens of thousands of pounds difference in terms of what they could borrow 8 months ago to what they could borrow now. And certainly at the higher loan to values, 70, 75%, it's just much, much more difficult to be able to get that buy-to-let mortgage, particularly on your sort of standard single family units.
And 25% is still the minimum as it always has been. That's not changed.
Yeah, exactly. That's not changed. So in theory, you can still buy a buy-to-let with a 25% deposit, but certainly around here, you're going to struggle if it's a standard sort of, just a family or professional let. The numbers are probably not going to stack up.
There are some lenders in the market, and this is, goes back to educating people within the market, that will look at doing something called top slicing. So what that is taking your personal income. So if you have a healthy personal income and say low outgoings, you will be able to top up what you need by utilising some of that personal income.
Okay.
So they won't take the whole affordability off what the rental income is coming in for the buy-to-let.
Yeah.
You may have the option to use your personal income to actually achieve the loan amount that you need.
Okay.
So you might see more of that coming forward.
For people who may be watching this and are looking to get into a buy-to-let market for a pension or a longer-term investment, and you obviously can't give us exact numbers because it's subjective to individual cases, but is there, you talk about stress testing. Is there a sum of money that, if my buy-to-let's getting me £800 a month, where can that mortgage go to, roughly? What they want in between, say, the £500 a month mortgage and the £800 a month income, is £300 enough for them, or are they wanting more than that nowadays?
Yeah, so it's, quite generic on a scale of looking at that question, because, you've got the different amounts that people borrow, the different property prices, the different amounts of rents that are coming in. But what we have seen is people's or landlords' rents in comparison to the mortgage going up, being squeezed and squeezed. So some even on a level playing field where the mortgage is now the same amount as the rent that's coming in. And with, being a landlord, you've got all your other costs involved, such as taxes, management costs, capital gains tax when you sell the property, wear and tear, repair fees, finding tenants, and that will have a big impact sort of on their top line. And they'll look at it, you'll probably get a few more landlords looking at saying, well, are we actually, is this profitable business anymore? And you may find that some that have a couple of properties that are getting, hiked on the mortgage rates and on taxes, etc., think, does it work out anymore? Or is now the time to maybe look at disposing of that and investing the money somewhere else?
Yeah, I mean, we've definitely got a client at the moment who is looking to get out. And that's, so she's probably in the later 50s, so she's certainly not a retirement age just yet. And there is a remortgage situation on the horizon, and they've instructed us to sell because she's looked at her monthlies in terms of her mortgage payments. She's looking at her exit strategy, and she's realising that when these rates that she re-enters it back into the mortgage market are going to be so much higher, she's not making any money. So her attitude is, well, I've done well, I'll take my money out, I'll pay my taxes, and I'll reinvest that into something else, or may aid her to retire early. But having had that conversation with her, there was never an intention to sell that property. That property in part of the portfolio was one that she was always going to keep. There were exit plans where she was going to use other properties to service debt, but that was one that she really, but it's the first one that's coming to its end of its fixed rate, and she's fixed into far better rates than what she's going to get. And that property's leasing for £1,000 a month. So you guys, knowing the numbers that you do, know how much she's getting squeezed on that. So it's an interesting one. Have you had many investment clients, buy-to-let, investors that you deal with who are coming to you and considering coming out of the market because of that?
Yeah, I've had a message from a client last week, and he's got 6 texting me saying, I've got 2 that I just want to get rid of. I just want to get.
There could be like a danger here where it could saturate the market if you've got a lot of, you have 5 or 6 properties there. I've got a couple, Ollie's got a couple. All of a sudden, there's a bit of danger there, I think.
The ones, your real professional landlords, they've got 20, 30, 40, they've had them over, tens of years, are probably just going to ride it out. And, they've probably got enough of a portfolio to, on some they're going to be making, some on others they're going to be making a slight loss, and it balances itself out. They'll probably stick with it. It's your ones, your classic example, self-employed, don't have a pension. Instead of a pension, I bought a buy-to-let. Those are looking at it and thinking, hold on a minute, I'm not really earning anything on a monthly basis. I'm getting clobbered for tax.
Yeah, I
just
mean,
becomes less attractive.
it does seem, as we've spoken before about, the investors look like the monsters in this world, don't we, to a lot of the outsiders, but we have to appreciate whether whether you're a landlord or not, that these landlords are incredibly important to the housing market in a bigger picture, and that be that it's providing much needed rental properties. If the government, more importantly than the interest rate, could attract more investment buy-to-let landlords, then the soaring cost of rents would come down, because there's a supply issue, which is why rents have continued to rise. Interest rates going up has hampered younger people and second, third time movers moving, so they might have to go into a rented property. I think there's a much bigger picture for us talking about mortgages on the buy-to-let world, that the taxes that are involved in that. It's not quite as hunky-dory and sunny as you think.
Let's not pretend there's not bad landlords out there, because
No,
there absolutely are,
yeah.
and I don't think anyone's suggesting that there aren't. But at the same time, this sort of perception that landlords are there stacking cash month on month is just not. It's not the reality. I'm sure there are some that are. But for most of them, they're just about making it work. Yeah. And for a lot of them, it just about worked when rates were at 2%. Yeah. It doesn't work when rates are at 5.5%, 6%. The numbers just don't.
In a way, being penalised for kind of trying to pay their own future, haven't they? Because you're always told, put money into a pension, and there's some good tax reliefs in putting monies into pensions. Yeah. But for those who have thought, do you know what? No, I won't put quite so much in my pension. Yeah. I'm going to save some money. I've inherited some money here. What do I do with it? Do you know what? I'll go and put a secondary investment in. They're not there. These guys and male or female, they're not there to make huge sums of money every month, but they're there not to lose money. Yeah. Otherwise, it is a bad investment. Yeah.
And often improve it and improve the stock of housing and do improvements to it, etc. There's all that side of stuff that doesn't get taken into account.
I think talking about improvements as well as maybe another little uphill struggle that's going to come for landlords, which potentially be the EPC changes. So
massively, yeah.
There's talks of EPC change now. It's not gone through, it's not been finalised, but if they do come in from 2025, you are going to see a lot of, depending where the demographic of the housing, how old is it, how achievable is it to get those EPC ratings to where they need to be. Yeah. You could see some landlords needing to spend 5,000, 10,000, 15,000 to improve the properties to be able to re-let it. Yeah. And it is, like we said all the way through, it's about planning your finances and being aware of something now so you can plan over the next few years. Right, am I going to need to release some money from this buy-to-let to cover all that work? Is that achievable, or do I need to dip into my savings? And it's just knowing, are you going to be in a position where you need to?
Yeah, I think we could definitely do with knowing some more clarity on what the government want us to do with the. I know there's some guidelines out there, and there's some provisional talks of 2025 and C rating, etc., etc. But in the reality world, from a lender, if the lenders are going to say, if you can't get to a C, we're not lending any money against it. There are some properties that just physically won't be able to get to a C. And I've got a major investor who has 30, 40 properties in the city centre where he's either inherited or he's bought big old Georgian Victorian buildings, which the ability to get those to a C, without turfing all your tenants out, taking it back to brick, starting again, which, effectively he's going to have void periods for months and months and months to get to that period, is going to be a huge task. And I think the sooner there can be some clarity on, is it going to happen? Well, I know the government have got lots of other things to worry about at the moment, but it would be very useful for you as advisors, us as agents to advise of how are we going to plan this into the diary? Because it can't just get into the end of 2023 and the end of 2024 and then we've got to do it, because there will be a mass exodus of rental properties in the market, which will only hamper those who are trying to get into the rental market. And we've already got issues with rental prices being at the levels that they're at, and it's eye-watering some of the prices that have been achieved. But it simply comes down to a supply, doesn't it? And if that supply gets less and less, it's only going to go one way. So it's going to be a really valid point, I think, you make on the EPC world. You can read as much as you want on it, but until the government come out and give us a little bit more clarity on it. We had our EPC provider in only a few weeks ago, and Neil's come up with a great idea where he's doing some pre-reports for landlords and for homeowners, if you want, where he will go out for the cost of a little bit more than an EPC, go out and give you an EPC rating as we are now. Doesn't register it, will then give you a report that says these are all the deals that you can get, this is what you need to get to, and this is what your rating will be. And then after you've done all that, he'll go back and do that report for you. And we've pushed it to quite a few of our landlords, and it looks as though there'll be some uptake on it. But, it shouldn't take for Neil in York to be having to do that.
Yeah, realistically, I think, given the silence around it, I wouldn't be that surprised to see it get kicked down.
I think it'll get moved on.
They've got a bit more on the plate.
I agree. Just while we're talking about deposits, have you seen any shift in deposits on a homeowner's, just expected deposit? You mentioned 5% earlier on.
Yeah, for residential, fairly much the same. I mean, through COVID, at the beginning of COVID times, a lot of lenders took away 5% deposits, 10% deposits, some took away 15% deposits, but we're fairly back to normal now in terms of deposit levels.
I don't know who I was talking to. It was somebody in the mortgage world, but...
must have been us.
It must have been you guys. I don't know if it was a buyer's... Anyway, it doesn't matter who it was, but there was some talk that it didn't matter quite so much now, that, you always used to get to 25% as your magic number.
It was us.
It might have been you I was talking to. I can't remember who it was.
Me,
But has that changed? Is it a bit different now?
Yeah, so there's notoriously, if you had a 5% deposit or a 10% deposit, your interest rate would be quite different to if you had a 40% deposit. But what we had seen, over the past 6 to 12 months is the sort of gap between those become smaller and smaller. We are maybe seeing now just it starts to increase slightly again, which is strange for the mortgage market, because usually, notoriously, the bigger deposit you had, the better rates were. But sometimes you could have been looking at 0.1, 0.2, maybe a difference.
To the point where it was kind of not worth putting down. You
might as well keep hold of your cash in the bank.
In certain instances, it did, like you said, definitely that gap is starting to widen. Widen again. Just going back to the buy-to-lets, one area that we didn't cover off that is actually doing pretty well is holiday lets.
Yes, yeah.
And I guess York is maybe a little bit of an anomaly, in that instance, but we do see, loads of landlords looking at switching to holiday lets, or people, first-time landlords looking at holiday lets, and the income.
I think there's a huge caveat to put in there, John, which for people who are watching, is that the holiday market is one that seems to be relatively lucrative, but people must ensure that they've got the right permissions in place, and the leases, if they're buying apartments, do allow them to do so, because speaking to a local holiday let agent recently, they have had a number of landlords who are now having to sell because the managing agents of properties have realise that they're actually in breach of their leases, which is clearly in breach of any mortgages that they might have.
Sure.
So I think it's really clear that yes, there's quite a lucrative market there with a holiday for the right property in the right location. But if you're going to do it by the book, which we would obviously advise people always to do. But I think the holiday. I think the only thing we're going to be probably careful with is in York is that whilst we've got a huge audience, haven't we, in terms of tourism that are going to come here, it's the multiple blocks of holiday lets which might start falling into HMO rulings and licences. It's going to be really interesting for me over the coming years to see whether they start taking the same. Local government taking the same views as they have done in other parts of the country, and particularly Eastern Coast towns and such like that. They're going to put restrictions on how many days they can be, but I certainly think in the short term there's a gap there, as long as it doesn't get saturated.
I was just going to say I'm yet to see one not stack up and not work in York, but you'd imagine there may come a point where it starts to get a little bit more difficult, and I think there has been talk of maybe even licensing them, which obviously would be another. But
it'll come back to what we said before about supply and demand. The prices are high in the holiday let world because there's there's quite a few, but the more that come into the market,
and the standard will improve, because the only way you'll be able to compete is if you have the really nice, specced out places, and all of a sudden then that. Is going to improve.
I have to say the Airbnb, Booking.com world in York, it seems to have a very, very high standard.
It's all come from the COVID reset, that hasn't it? In terms of how people go on holiday rather than going abroad, they've actually sort of utilised what we've got in this country.
But it all links again, doesn't it? That we were talking about taxes before, that in the holiday let world, there's more tax reliefs.
Yeah, there are.
You can offset far more tax. So, it's almost like the government have said, well, we'll tax you a load on this. They don't want all these holiday lets, but actually, if you go into holiday, we'll give you much more tax relief. So, they're throwing landlords from.
You do wonder whether they'll close that, because it's a nice, easy win, isn't it? No one's going to complain, are they? It's one of those. But I think, going back to what you said, we do just need to be careful as a city that it doesn't become, just a holiday destination, and all the city centre flats are just empty during the week and then rammed at the weekend.
Yeah, I think I've got huge sympathy for those who have lived on a terraced house in the city centre for 20 years, and they've had nice tenants or nice neighbours, whether they be tenants or whether they be homeowners for 20 years, and then all of a sudden someone puts a loft conversion in and puts 4 lettable rooms out of it, or 2 flats in it, and then all of a sudden there's party comers and stag do's and hen do's and all male or female parties that are in there. I think those are the properties that the council and the governments have got every right to put some
like
restrictions
you say, right
in
property,
place.
right location.
But you and the wife decide, we're going to go to York for the weekend, and you find a lovely little apartment on the river or whatever it might be that has permission to run as a holiday let. Then I think that's a good way to come and enjoy the city, and that's something that we should be encouraging as a city, not trying to be difficult with. But have you seen? Has there been much change in the rates for people? Because it's more of a commercial loan, isn't it, than a residential buy-to-let loan?
So with holiday lets, you have a much smaller pool of lenders to fish in, basically, than a normal buy-to-let. And like going back to what you said, Oliver, it's important that you have the right mortgage for a holiday let, because if you have a standard buy-to-let product on a holiday let, you potentially could be in breach of your mortgage conditions. So one thing is important is speak to a broker when you're looking at a holiday let, because they will have probably the widest reach of options for holiday lets out of the small options that are there. And they are tested differently on affordability. So a lot of them, they'll take a low season, mid-season, high season and base it on that amount of rent, where you might get others that will only value it on what you'd be getting on a normal AST. So there's a big difference in what you can borrow between the lenders as well. But rate-wise, we have seen increases in rates with holiday lets, maybe a tiny bit higher than the sort of normal residential buy-to-let, but probably around where they should be in line with market conditions at the minute.
Yeah, I should say with holiday lets, generally speaking, you would normally be able to go up to 75% loan to value, because the rental income's normally much higher. You don't have that issue that you have with a standard buy-to-let where you need a 40-50% deposit in York. They would normally stack up at the sort of higher loan to values.
Fine.
I'm going to ask the $1 million question. How do you think this year's going to go in terms of the mortgage rates? Are we going to see a better sort of year this year than with what we saw sort of back end of last year? Because how you guys are in the mortgage world dictates how the marketplace is and how that plays out. So I think for the majority of our listeners and me personally as well, how that's going to be, this year we're going to see a new norm at the rates that they are now, or they're going to go up, they're going to go down. Just interested to get your views.
New norm's the definite, the word there. I think anyone who's sitting around hoping or waiting for rates to get back down to 1 or 2%, as it stands, going to be waiting a long time, because it's just not on the horizon. And I think certainly from what we're seeing, rates have definitely come down from where they were. So they sort of peaked, I would have said October-ish sort of time, November maybe, towards the end of last year, and they've been slowly coming down. Fixed rates, yeah. And, we've hit 2 weeks ago, maybe had the first sub 4% deals come back into the market. And, that is only is a positive thing. And, hopefully that will continue. And I think if we could get somewhere between 3-4%, that might become the sort of new norm.
And it is so relative, isn't it? Because when you mentioned there the mortgage rates at the back end of last year, I know notoriously for the housing market, the back end of the year is quiet, but at Selby we had a very quiet sort of back end of October, November, December, and it's tied in with exactly what you've just said there in terms of higher rates.
Yeah, a lot of it was kind of like paralysis, like everyone just kind of stopped what they were doing.
Yeah, panic stations.
Yeah, exactly, yeah. So we had loads of people put stuff off, didn't we?
Yeah, we did. I think notoriously at the end of the year, it usually slows down in the housing market towards Christmas, but I think there was sort of double trouble maybe at the end of last year. There was a lot of uncertainty.
I think a confidence thing as well.
Yeah, a confidence knock. Whereas I think now we've settled into a period where there's a bit more clarity, and people will maybe start to make those decisions again. But lenders do want to lend. They're there to lend, and they have their targets to meet, the amount that they need to lend out. And we've seen a bit of a price war at the beginning of the year on fixed rates, and that's why you'll see them coming down and down. Whether they remain at those levels, and depending on what the Bank of England does, over the coming months, is yet to be seen. But it's been good news at the minute at the start of the year on fixed rates.
There seems to be a lot more positivity in terms of the interest rates this year.
I think if you look at affordability with rates at 5, 6, 6.5%, it just doesn't look good. It's difficult to see how the housing market could really flourish. If you then replace that with rates at 3.5%, it's a completely different picture.
Yeah, absolutely.
So I think if we could get to that point, things would start to sort of loosen up a bit more.
I know one of the biggest questions Tom and I will be asked on a weekly basis is now the right time to buy? And I know what our answer is. My answer is always that if you need to move or you want to move and the finances allow and it's a medium to long term purchase, then absolutely get on with it. What would your advice to be anyone who's looking to buy at the moment?
I think just, make sure it's the right time for you. It's all personal perception on, do you need to move? Is it the right time to move? What will that move give you? And we speak to a lot of people, and so many people are now sort of concentrated on the investment side of buying a house as opposed to what it actually gives you lifestyle, memories that it makes. And if you're going to start a family there, if you're going to be there 5-10 years, why worry whether, you might buy it and then it might dip a little or house prices might drop a couple of percentage points? Because if you think long term, it's going to give you a lot more out of your lifestyle than worrying about the investment side of things.
Yeah.
But in terms of if you're looking at buying, what I would say is, pick the phone up, speak to a broker, even if it's not us, if you know someone who's used a broker before, there is no charge for speaking to someone like us. It could be a 10-15 minute phone call that makes what you think is the unachievable, achievable, and put you in a completely different position for the year ahead.
And I think that probably moves on to, you'll have to tell us so the guys that are watching know or listening will know how to contact you. What's the best way to get hold of you guys?
I'll leave that to you.
Yeah, so you can look us up on Google. So we've got some great Google reviews. We've got a website that covers sort of all the product ranges that we do. Pick the phone up, phone number's on there, drop us an email. Find us on Instagram, LinkedIn, on social platforms as well.
We'll put all your details in the details below.
Much appreciated.
John, Graham,
Thank
for
you.
joining us.
Thanks very much.
Cheers. Spot on. Was that the practice run?